I came into this business when I was at Princeton, and I worked for a brokerage firm in the summer. And one of the old runners said, Bogle, I'm going to tell you everything you need to know if you're going into the investment business. And I said, what's that, Raymond? And he said, nobody knows nothing. And that's true. We don't know what the future holds. We guess, we look at the past, sometimes it misleads us, sometimes it leads us correctly, but we can't tell the two apart. And the markets are very hard to deal with because we have all these opinions out there, and we've got to say, I'm smarter than everybody else. And that just isn't going to happen.
When is it appropriate, in your opinion, for an individual to buy stocks? Is there a level of expertise or interest, an amount of time you should have, or capital, or it should be a side frivolity in a base portfolio of index funds, et cetera?
That last sentence captures it best, and that is, you should have a serious money account. I might even call it a boring money account, where you put money in the stock market index fund and balance it out a little bit with some bonds, depending on age and so on. And don't look at it. Don't look at it for 50 years. Don't peek. But when you retire, open the envelope. Be sure a doctor is nearby to revive you. You'll go into a dead faint. You can't believe there's that much money in the world. And that's where we fool ourselves. So that's a serious money, boring money account. We have a gambling culture here in this country. Maybe every country does. You see it in its finest manifestation, or maybe I should say worst manifestation, in the lottery, state lottery. Las Vegas contributes its share. The races contribute their share, the track, and all these are just gambling, where a whole lot of people bet their money, and a whole lot of people take their money out, and the croupier wins. The house wins.
3 to 20% of whatever has
whatever
been bet.
It is.
You put $1 in, you'll lose.
So I'd say have a funny if you have the gambling instinct, and most people do. At least start off. I mean, I'd say start off with an index fund, period. And for 5 years, don't do anything else. And then look around and see what's happened in the 5 years. See how it felt when the market dropped 50%. See how it felt when it came back. And those 5-year periods are going to be very different for one investor and another, but because they're all over time. But then when you get there, 5% in the funny money account.
What would have happened to Warren Buffett if he had done that? He would have, a tremendous amount of value would not have been created by his understanding and ability to evaluate a business for investment.
Well, name two.
Well, Longleaf, you mentioned Longleaf, dodging Cox.
But they don't have the sensational returns. They may probably have something above par returns, but maybe a little bit below par from time to time. So, and then don't forget in Warren's case, he wasn't running a mutual fund. The mutual fund is a badly structured business for investment management. We say, and this is the way it has to be really, you can take your money out whenever you want, and you got to be ready to put it in whenever you want. And so you ride on these waves of optimism and good performance, and the money comes in up here, and then reversion to the mean, which is a big part of my recent book, a big part of the final chapter of my recent book, called Clash of the Cultures. And it's happened everywhere. It's happened in Magellan Fund. It's happened in T. Rowe Price Growth Fund. It's happened in our old iVest Fund. It's happened in Fidelity Trend Fund, which Ned Johnson happened to have run. It happened in CGM, all the hot funds. They were all in there for the last 25 years, and they all look like this. You put them over each other, looks like the Himalaya Mountains. The reversion to the mean is a constant pattern.
For the individual, I'm just going to poke around here a little bit just to get your full philosophy. For the individual, it's unlikely that you're going to hit the mountaintop of the Himalayas with your portfolio. So you may not have to ever see the other side of the mountaintop unless you have so successfully invested that your personal account is moving up in the $1 billion.
Let's say you bought Magellan before it was for sale, which is where that record begins, by the way. There's a lot of phoniness in this business. But you're going to enjoy the mountain. And you're not going to know it's a mountain. But when that mountain gets up there, you think, my God, I found the Holy Grail.
Now I'm really going to go all in.
And now I'm going to go all out. So there's a lot of behavioral kind of stuff, not to use too fancy a word, in the mutual fund industry. Interestingly enough, Tom, there is no behavioralism in the field of stocks generally. How could that be? That is because I'm a dumb behavior. The guy that buys my stock from me is a smart behavior. we offset each other. I mean, it's not as if it's not as if I can make a behavioral mistake without somebody else making a successful behavior thing, the other side of the trade. So I think we take a lot for granted. We listen to all these theories, and big, old, boring indexing is the answer.
First, I'd like to make a distinction, Poppy, about the difference between an investor and a speculator. I mean, this kind of volatility in the market is entirely caused by speculators. People that are trying to catch the latest wave of sentiment, the latest words of the Fed, the latest developments in Europe, the latest problems in Washington, and the latest economic data. And that has very little to do with a long-term economic plan. And so I'd say try and ignore the noise. The rule for most things in life is don't just stand there, do something. But in these kind of circumstances, and for the long-term investor, the rule should be don't do something, just stand there.
You said earlier this month, not long ago, that we are likely heading into a second recession for the United States, right? Or that we could be.
I think the chances are probably 50-50 at least that we're going into a double dip.
Given that, how should investors react? I mean, should they get out now and sell at these levels if we are falling into another recession?
Well, I mean, I think you should invest for the long term. And if you're investing for a lifetime or for the next 15, 20 years, whatever it might be, in that period, looking ahead, there are going to be a certain number of recessions, a certain number of booms, a certain number of good times and some bad times. That's the way the markets are. And to try and get in at the bottom and out at the top is simply impossible for anybody. But it's a very good bet that stocks will do significantly better than bonds over the coming decade.
How would you advise investors looking at commodities right now? I mean, there's been such a rush into gold, especially lately, but really over the past few years. Is gold at these levels a wise investment for an average investor?
Well, I think no. And the reason I say no is gold is not an investment at all. Gold, to go back to where we started, Poppy, is a speculation. It has absolutely no underlying intrinsic value. Bonds are ultimately supported by interest coupons. Stocks are supported by dividend yields and earnings growth. And gold is supported by, the ability to think somebody else is going to take it off your hands for more than you paid for it. It doesn't have an internal rate of return. So it's a speculation. Is it a good speculation today? I don't know that I'd be much of an expert on that, but it's gone so high so far that I'd be very skeptical of it. But if you really are bitten by the gold bug, and it seems like an awful lot of people have been bitten by the gold bug, and if you want to speculate, maybe 1 or 2 or 3 or even 5% of your assets in gold is not the worst idea in the world, but I wouldn't do it myself, and I wouldn't advise most investors to do it.
What about corporate bonds? What's your take on those right now?
Well, I mean, I think corporate bonds are, in the AA area, have good premium yields over the treasuries. You want to be very diversified, and I would certainly recommend a bond index fund, a corporate bond index fund perhaps, or a total bond market index fund, which is dominated by treasuries and mortgage backs. But diversify that corporate position, because one bond can cost you a lot if you're on the losing side of the game.
There is this feeling among some just Main Street investors, if you will, who are telling me, look, I feel as though high-frequency trading is really taking over this market, and I can't play in that game. What would you say to them? I mean, how much of the volatility over the month of August would you attribute to high-frequency traders, and what does it do to the average investor's ability?
Well, average investors should absolutely, as they say, I can't play in that game, was I think the quote you used. They shouldn't play in that game. It's like going to Las Vegas and gambling. Why would anybody want to do that when you know that the house takes more than the winnings than the winners and losers combined? It's not a zero-sum game. It's a loser's game, whether you're at the racetrack or at the state lottery or in Las Vegas. Ultimately, you lose. Pick your stock market, pick your bond market, pick your stocks even if you buy a very diversified list, and then get out of the game because you can't play it. It's the cards are really stacked against you with this high-frequency trading, and we should be looking at long-term investing. the wisdom of long-term investing, Poppy, is the way I'd express it, and just ignore the folly of short-term speculation. It's absolutely a loser's game.
Have you ever bought individual stocks and or actively traded funds? And if so, what do you look for in those investments?
Well, when I came into the business, I had friends in the brokerage business. I bought this and that and the other thing. And then I had a broker. And he would tell me this was good, get out of that and get into that. And it wasn't that they did badly, which was, of course, what they did. But it was, I just couldn't stand to have my phone ring when I was trying to do my work. So I haven't owned individual stocks since, let me say, 1960. I don't know exactly, a long, long time.